Once upon a time in Istanbul, Turkey, a bizarre macroeconomic experiment was underway. It was supposed to bring respite to the struggling economy, but instead, it plunged the country deeper into a state of economic malaise. The unexpected re-election of Recep Tayyip Erdogan as president on May 28 sent shockwaves through the investment community, leading to further troubles. Over the past fortnight, the Turkish lira lost a staggering 5% of its value against the mighty dollar, reaching a rate of 21 to 1. Some economists even predicted that it could plummet to 30 by the year's end, despite the government's desperate attempts to prop it up. The central bank's net foreign exchange reserves found themselves in the red, as savers and investors fled the currency, exacerbating the crisis. These difficulties were merely symptoms of a perplexing eccentric monetary policy. In a time when central banks worldwide were raising interest rates to combat inflationary pressure, Turkey took the unconventional path and decided to cut them. The belief was that low rates would magically lower inflation, defying economic orthodoxy. President Erdogan relentlessly pressured Turkey's central bank to slash its policy rate, which currently stands at a surprisingly cool 8.5%. Official figures revealed that annual inflation reached a staggering 86% in 2022, although it has since softened to around 44% according to official estimates, or possibly higher, according to independent sources. Despite the glaring flaws in this approach, President Erdogan remained adamant. In his victory speech, he confidently proclaimed that inflation would fall alongside looser monetary policy. While inflation did experience a temporary drop due to various factors such as falling energy prices and central bank interventions, the fundamental issue of negative real interest rates remained. This meant that Turkey's real interest rates had been deeply negative for a considerable time, creating an unsustainable situation. Speculators took advantage of this situation, profiting from borrowing in lira and investing in more stable assets, further devaluing the currency and fueling inflation. It seemed perplexing that hyperinflation hadn't already reared its head. To understand this economic puzzle, one had to delve into President Erdogan's approach. His advisor, Cemil Ertem, referred to the famous Fisher equation, which stated that the nominal interest rate is the sum of the real interest rate and the nominal interest rate is the sum of the real interest rate and the nominal interest rate is the sum of the real interest rate and the expected rate of inflation. The theory suggested that lowering borrowing costs would reduce inflation if firms passed on the savings to consumers through lower prices. However, when put to the test, President Erdogan's theory proved wrong. Inflation continued to rise, as other channels through which interest rates affect inflation outweighed the cost channel. The mystery of Turkey's persistently negative real interest rate starts to unravel when considering other types of real rates that haven't been as negative. Government policies have distorted interest rates in certain sectors. Banks, for instance, are forbidden from lending above a certain interest rate, causing them to avoid making most loans. Only favored industries, such as construction, receive credit. Furthermore, the government has required banks to hold bonds against foreign exchange deposits, essentially subsidizing state borrowing. In sectors where interest rates are less distorted, nominal interest rates have moved in the opposite direction of the policy rate. Investors no longer trust the central bank to act against future inflation, leading to higher inflation expectations. This, in turn, translates into higher consumer lending rates, especially for longer-term loans, as investors demand a higher return due to the expected depreciation of the lira. Therefore, when assessed based on consumer loan rates, real interest rates may not be as negative as initially thought. At the same time, returns on other assets far exceed the central bank's policy rate, causing businesses, households, and investors to flee the currency. While the government tries to support the lira, its options are limited. Some resort to pricing items in dollars, while others seek refuge in alternative investments to protect their savings. House prices have skyrocketed, growing at a rate triple that of inflation. There are even speculations about a potential attack on the lira by foreign investors. The government has implemented measures to stem the flight of currency, such as requiring exporting firms to sell 40% of their foreign currency revenues to the central bank. Additionally, a scheme was introduced to protect some lira deposits against depreciation, covering almost a quarter of all deposits, an expensive and potentially unsustainable solution. As for the famous Fisher equation, short-term policy rates have indeed been negative. However, they have become less relevant for borrowing as market rates rise due to higher inflation expectations or as credit becomes rationed. The result has been a mass exodus from the lira, prompting the use of soft capital controls. It is believed that if President Erdogan were to force down market interest rates across the board, the consequence might very well be hyperinflation. Some economists speculate that, armed with victory but facing a looming currency crisis, President Erdogan may soften his approach. The summer months might provide temporary economic respite as energy consumption falls and tourism revenue rises. President Erdogan has managed to keep the lira afloat through foreign exchange agreements with friendly nations like Russia and Saudi Arabia. However, come autumn, he may be forced to reconsider his low-rate policy, possibly through indirect means such as relaxing limits on commercial lending rates. Warm weather and friendly favors, as it turns out, do not last forever in the complex world of economics. Once upon a time in